Well, hello and a very warm welcome to today's webinar, European Banking Outlook 2023, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator today. And I'm delighted to be joined by Marco Troiano, Head of Scope's Financial Institutions team, who in a few moments will outline the key factors driving his views on European banks. Now, today's comments follow publication earlier in January of Scope's Banking Outlook Research Note, which is available on the Scope Ratings website, www.scoperatings.com. Now, Marco referred in that research note to European banks as strong ships in turbulent waters, hence the subtitle of today's webinar. Now, after Marco's delivered a short presentation, we'll move to Q&A. So please do type your questions in as we go along. And once Marco's finished, we'll do our best to answer them. So that's it from me. Marco, great to see you as always. Let me hand the floor over to you.
Thank you, Keith, and good afternoon, everyone. I hope you can hear me well. For the ones that are not familiar, I'm Marco Troiano. I'm heading the financial institution group here at 4Rating. We have 12 analysts split over 5 different locations, and we rate over 100 European banks and 4,000 bonds. Today, the idea is to summarize for you the team's view on what we expect to be the direction of travel for 2023, something that we have detailed in a report, our annual outlook published a couple of weeks ago. As Keith mentioned, it's titled Strong Ships in Turbulent Waters to highlight our relatively constructive view, I would say, of credit risk and financial stability of the European banking sector entering the new year, despite what we see as a fairly complex environment. Now, in fact, before I turn to our expectations on the banks, my first few slides are reviewing the turbulent waters and in particular financial conditions and the macro environment. So starting with financial conditions, and on these slides I reference the Financial Condition Index, which is a proprietary measure developed by Scope, in particular by my colleague Dirk Brandenburg, which looks at the evolution of several key asset markets, including equity, rates, credit, energy, commodities, and currencies, both in euros and in dollars. For the purpose of today's presentation, I will focus on financial conditions in Europe, of course. What we see, and sorry, I went to the wrong slide. What we see towards the end of 2022, we've had some easing, of course, in financial conditions in parallel with the market's rally, and in anticipation of a potential early pivot from central banks, including the Fed and the ECB. Nevertheless, we highlight that conditions remain very tight following the sharp tightening in 2022, as markets essentially anticipated the rising recession risks globally and in Europe in particular. Now, the key drivers, I guess, are well known to most people on this call. So the Russian invasion of Ukraine, high inflation and the reaction from central banks, and of course the energy shock. So where do we go from here? I don't know. If I knew, I would be a very rich man, but there is a very broad range of scenarios. And I'm going to start by showing what our expectations at Scope are about macro environment for next year. So at the global level, we are forecasting a very sharp slowdown in 2023 to 2.6%, which is below medium-term potential before a V-shaped rebound in 2024. And this should reflect, again, the second round effect from the energy shock and war in Ukraine, as well as the very aggressive monetary tightening from the major global central banks. When it comes to Europe, pretty much the same pattern, sharp slowdown and then sharp rebound with a very high possibility of technical recessions and, in fact, outright recessions for the year in Germany and in the United Kingdom. Now, under our base case, inflation peaks in 2023, but remains quite high, which means we are not really holding our breath for an early pivot from central banks. Now, I think before we move on, I want to make a couple of fine points here. So the first one is, this is an engineered recession. So it's a direct consequence of central banks' attempt to contain second round's effect. We know very well that this inflation, especially in Europe, is mostly exogenous, coming from the supply chain shocks still related to the long tail of COVID and energy prices. But we had very tight labor market in some core European countries, meaning that the risk of inflation price wage spiral was actually quite high. And what we're seeing is central banks pouring cold water over the economies to avoid the price dynamics becoming more entrenched and affecting expectations. For me, this has one important implication, is that the monetary authority is well in control, and that the risk that this recession turns out into an economic rout is very limited. The second point I want to make is that this environment is bringing new challenges for the European Central Bank in particular. The first one is to balance or walk this very tightrope between stagnation and contraction. So not a deep contraction, but something that is sufficient to cool down labor markets, and act in concert and react to what other actors in the economy do, including the fiscal authorities. And the second one is that the ECB now has to strike this balance regarding its own public perception. They got a lot of criticism in the past for essentially pumping too much money into the economy and contributing to the economy overeating. Now they're doing the opposite. The risk is that they do too much, and in the future they can be seen as culprits for inflicting too much economic pain. So I think this balancing act is difficult. There is some risk of policy mistakes one way or another. But either way, this is not a recession that is coming out of the blue and on which the monetary authority has no control. Turning on to European banks, there are essentially 4 messages that I would like you to take away with you today. The first 3 are actually watershed moments compared to recent past, and are the essential stability in banks' profitability, but at the same time, the composition of this profitability being very different than in the past, and we'll go into more details in a minute. The reversal in what is now a more than a decade-long trend of improving asset quality for European banks, and the end of cheap money and what it means for bank liquidity. So these 3 points mark a significant change from the recent past. And I think it are 3 themes that we need to watch very closely in 2023. The final point, capital will continue to support credit, and in particular our ratings, is an element of continuity with the recent past, and we'll dig into more details also on this point. So jumping in on starting with the P&L. And actually, I need to make a methodological note. For this exercise, for the numbers you see on this presentation, and for our outlook overall, we have selected a sample of 50 banks, the 50 largest banks in Europe that we rate. We've modeled our financials for the next couple of years and projected essentially key P&L and balance sheet items. So the key message that I want to pass here is that profitability will remain resilient. And then let's have a look at the shifting drivers, which is what I was mentioning before. So the most obvious one, net interest margin, which has been on a declining trend for several years, and you can see in the first chart on this slide, clear downward trend, has now turned, and we expect it to actually perform quite strongly in 2023. This is the direct result of the change in the interest rate environment. We know that banks tend to be positively geared to rising interest rates, and that is going to drive revenue growth for the vast majority of banks in our coverage. The other side of the coin here is that both lending volumes in terms of demand and commission income might actually be a bit softer than what we're used to, especially in 2021, 2022. In particular, I think asset management fees tend to benefit from a low rate environment as clients' money goes around seeking better remuneration. And as interest rates lift off the zero ground, I think there is more competition ahead for client funds. So that's probably going to be downside for those banks with more diversified business models, at least in the near term. When it comes to operating efficiency, we're again going to see a big difference compared to the past. Cost cutting has been left, right, and center over the past decade as banks essentially adjusted their capacity to post-GFC world. We think they're going to continue to do that, but in an inflationary environment, it's going to be a lot more difficult to see declines in the cost base. So we expect banks more and more to turn to absolute cost targets. And in general, the main driver for operating efficiency improvements going forward is not going to be on the cost side, but it's going to be rather the revenue growth itself. Moving on to the lower part of the P&L. As I mentioned, improving efficiency driven by revenues will drive a turnaround also in pre-provision profitability. This is a key metric we look at because for us, it's the first line of defense. It shows the ability of the banks to absorb potential problems, increases in provisions, or even one-offs through ordinary profitability. So this increase in pre-provision profitability is a key positive element in our analysis. That's going to be partly offset by an increase in cost of risk on our forecasts. You can see on the second chart on this slide. I'm sorry, but it keeps moving. In 2023, we're actually forecasting cost of risk to go up to 40 basis points on average for the sector. This is well within the ability of the banking industry capacity to absorb them out of ordinary operations. Of course, as a rating agency, we do our plausibility checks on our estimates. So we look at how our forecasts are comparing with consensus. In generally, I would say we sit comfortably below consensus for 2023 and 2024, which shows some conservativeness in our assumption. And the last chart I'm showing here is, in fact, showing a trajectory of ROE for the next year in 2024. And you can see it's pretty much on par with recent history, which goes back to my initial message. Moving on to asset quality, I would say our key assumption here, as I mentioned, is a reversal in a very long-dated trend of improving balance sheet quality. The main driver, and you can see the trend on this slide, both on a shorter history, but also on the second chart on a slightly longer time scale. The driver here is, in fact, this stagflationary environment. So the combination of rising debt servicing costs and cost inflation on customers, which will weigh on households and corporate finances. It is important to stress that the starting point is very good. You can see again from the top part of the slide, banks have really come a long way in cleaning up the legacies of the previous crisis. It's also worth mentioning that there was no no cliff in NPLs from the COVID-19 crisis, including when the moratoria programs expired, and that the migration from substandard to stage 3 loans was, I would say, very manageable. This was a little bit of a surprise to me, at least. We were expecting some deterioration in the course of 2020-2021. We, in fact, initially dubbed COVID-19 as potentially an acid test for the bank's de-risking. The reality is that this acid test was not really successful in terms of actually showing weaknesses. And part of the reason is that it was accompanied by massive stimulus, both fiscal and monetary. So I don't think we can draw too many lessons from that one. But perhaps this upcoming recession is going to be a better test for the de-risking in the past 10 years of this sector. Moving on further to liquidity. That's the other key message I wanted to convey, is that we've seen over the past couple of years very significant improvement in all sort of liquidity metrics, both market and balance sheet. We've seen, I've put on this slide distribution of LCR, and sorry I didn't put it in the title, but these are LCR ratios over the past 5 years. You can see that there is a strong increase in LCR, which are well above 150%, and the number of banks reporting LCR below 140% has declined quite materially since with COVID, essentially, with the measure introduced by central banks as a response to COVID. Now, these measures are going into reverse. We've already seen a decline in TLTRO outstanding amounts and early repayments of TLTRO. We're probably going to see further balance sheet shrinkage from the ECB in coming years. And my message is that this is going to have an impact on bank liquidity metrics for the worse. Bank liquidity metrics are going to deteriorate from very strong levels, but they're going to deteriorate. So that's going to be my third big sort of watershed when it comes to banks' performance in this new environment. And to finish off with some stability, capital. Here you can see the buffer of CET1 ratios to the requirement for the banks in our sample. You can see that this measure has been on an ever-increasing trend for the past decade. It plateaued over the past few years, and there was actually some decline since the peak in 2020, 2021. This was driven by generous dividend payments and buybacks over the course of the past 12 months, following the dividend ban actually in 2020 and 2021. My expectation is that this is going to continue to be a strength for the sector, and that we're not going to see a very significant decline in 2023 here, as in the face of uncertainty, banks are actually tend to be more cautious with distributions, and supervisors tend to also sort of nudge banks into not distributing excess capital while visibility is very low. We've also seen last year some supervisory drive to start reinstating precautionary buffers. So I would say CET1 and capital in general will remain very abundant compared to requirements, and will be a source of strength for the banking industry. I would say that is the main messages I wanted to pass. I have an additional slide, and this is part of the exercise we conducted for our annual outlook, and which is included in our report. We've obviously played with our assumptions quite a bit, trying to bend them and find out the vulnerabilities. In particular, we've presented 3 scenarios. The first one being a flat NIM scenario, so a scenario in which banks' net interest margin remains stable, reflecting banks' inability essentially to pass on rate increases on the asset side faster than on the liability side, which could be due to competitive or even political hurdles. A second downside scenario where inflation turns even nastier and affects the cost base to a greater extent than in our base case. In our base case, we're around 5%. In our stress scenario, we're about 10% cost growth. And also affects the credit quality of borrowers, so that essentially more companies go into defaults. We reflect that by adding 50 basis points to our base case cost of risk, so from 40 to 90 basis points. And in our third and probably more severe scenario, we actually assume that there is a policy mistake, authorities lose control of the trajectory of the economy, and we end up in a much deeper recession than our base case, and we reflect that by trebling cost of risk to 120 basis points versus 40. Perhaps it's useful to give you some context. Cost of risk at the peak of COVID 2020 was actually around 60 basis points, and this included a lot of precautionary provisions and model provision to cover for macro deterioration, which at the time in some countries was up to double-digit declines in GDP. So this is a very severe cost of risk assumption. And conservatively, we've also maintained net interest margin flat versus the base case, meaning the higher rate rises don't materialize in better commercial conditions for bank margins. Now, as you can see from the first chart on the slide, under the last two scenarios, profitability is basically obliterated. In effect, in one of the scenarios, banks turn a loss on average for 2023. But even then, the capital erosion for the vast majority of banks is very limited. In fact, it's only a handful of banks which sees capital erosion of over 300 basis points. And these are those banks which are more exposed to emerging markets or that have a very high starting cost of risk assumption because perhaps of some legacy issues, so almost by construction. This, I think, supports our view that even in very stressed scenarios, because of their capital strengths, banks are relatively well positioned to navigate these turbulent waters. And with that, I've come to the end of my presentation, so I will hand back to Keith and see if there are any questions.
Good, thank you very much for that, Marco. Some great insights there. So please, as Marco says, please type your questions in to the section, into the relevant window, and we'll do our best to answer them, and as we said. I know one or two of you have come actually said that you can't either see the slide presentation or you get a rotating arrow. Look, I think these are potentially almost certainly going to be firewall issues at your end. So apologies for that, but we will distribute a YouTube link where you can watch the whole thing with all the relevant slides to view. So with that, Marco, you mentioned at the very beginning that your basically your outlook is supportive of where you have your bank ratings. There's a question here about where is the average rating for the European banking sector?
Yes. So we rate mostly large banks. Many of our ratings are on an unsolicited basis. So we tend to rate the national champions in the main European countries. I would say our average rating is in the single A range. But that mostly reflects the type of coverage that we have. So really top 2 to 4 banks in each of the major countries.
Okay, and the rating outlook, I guess, backing up your comments would be, I guess, stable would be a way to describe it, right?
Absolutely, absolutely. We've actually come into 2022 with a already with mostly stable outlooks. We had stabilized them over towards the end of 2021, beginning of 2022, following the COVID shock, where we had a slightly more negative view. And this time around, we see the situation actually with more comfort, and we're a bit less worried about the positioning of our ratings. There will be, of course, more marginal, I would say, situations, some more vulnerable names, but these mostly reflect weaker business models to start with, or situations where you have a work in progress on finding the right perimeters, business models.
Yeah, that makes sense. Now, you talked about liquidity in your comments. And there's a question here which says, could you please elaborate on the drivers of liquidity deterioration? And do you see any banks going into difficulty due to lack of liquidity?
Of course. So what I'm trying to say here is that we've had a couple of years where a lot of liquidity was created by central banks through a number of channels, of course, bank lending channels, as well as quantitative easing and purchase programs in Europe. This liquidity, once in circulation, ended up back on banks' balance sheet, and we've heard over and over that banks had excess reserves redeposited with central banks. Now, these amounts, excess reserves deposited with central banks, are the liquid asset par excellence, and as banks reduce this excess liquidity because, for example, they start repaying TLTRO because it's not so convenient for them anymore to hold this excess liquidity, probably we're gonna see a decline in the stock of high quality liquid assets, which is of course the numerator for the LCR ratios. So this is a little bit the channel. And in terms of banks going into difficulty due to lack of liquidity, in fact, no. In the immediate, we don't see that as a risk. There has been a lot of growth in customer deposits over the last couple of years. There are not a lot of banks, or I would say marginal banks, that rely excessively on short-term wholesale funding these days. Banks that do rely on wholesale funding tend to have very well-established names in the market, so I don't see issues with them, raising funding from a liquidity perspective. The one aspect that we debate a lot is more around the need for some banks, especially second tiers in Southern Europe, to raise MREL funding for regulatory purposes, and that for banks which are not frequent issuers might come at a very high cost, or potentially carry more risk. So that's probably where I would say I see a bit more risk.
Yeah, in fact, you segued perfectly into the question that's just come in about MREL funding. Now, clearly, this year, or perhaps towards the end of last year, we saw quite a big spike in the cost of wholesale funding in the debt capital markets, and it's come down a bit actually in the beginning of the year with this funding frenzy. But this question of more expensive MREL funding, can you just summarize? Do you expect this to be a big problem? Are there any some markets where you think it might be? I guess you've already alluded to certain other markets, but yeah. Does this figure highly in your on your list of concerns?
No, it's definitely. I mean, it's a cost issue first and foremost, but in the big scheme of things, in the context of banks repricing their entire asset side to the upside, I think this is going to be more than offset by the positive on net interest income. So it's going to negate part of this repricing, but not entirely. So yes, it's one factor going into our NII expectations, but not the main driver.
Understood. Now, in your comments, you identified net interest margin expansion and rising costs of risk as, I guess, drivers for this year. You may not want to get down to specific banks, but are there any countries or even banking business models that are more or less geared to those drivers?
Yes, I mean, on the margin expansion, I would say it is primarily a business model issue. So you have when in our sample of large European banks, you have some very diversified groups, which range from commercial banking to insurance to asset management, and you have some more specialized or still broadly diversified, but pure banking, pure commercial banks. Now, I would say pure commercial banks are more geared to this trend, of course, less diversified, while banks that have more exposure to wealth management, I would say in general, will see an offsetting impact from a slightly more difficult outlook for asset management product sales as well as performance. The driver here is that when interest rates are very low, of course, holding deposits at a commercial bank, it's a highly unproductive use of money, and clients tend to look for alternatives. So advisors have a very easy time, selling different products, which typically carry higher margins for the banks. When interest rates start to rise and are at the current levels, you have more competition for those funds. So asset management outlook slightly less positive. So I would say definitely there is some differentiation there. The other key element is the structure of the book. You have markets where typically you have more competition for client funds, which might negate a little bit the repricing on the asset side. You have markets which are slightly less competitive, more concentrated in terms of structure, which have consolidated over the past decades already. And I think in these markets you're going to have a sharper increase in NII. And with respect to risk and cost of risk, again, I would flag banking systems which have historically shown to be slightly more cyclical. I'm sitting in Milan. The Italian, I think, banking industry is a good example. It's more concentrated on SME type of lending, which tends to be more cyclical and more sensitive to deteriorating operating conditions. So again, I would say a mixture of business model and, in the case of risk, also of core versus periphery.
Yeah. Okay. Thank you. So in the past, I guess a completely different question here now, Marco, but in the past, you've talked about consolidation of the banking industry. And we did indeed, in recent 2-3 years, see some consolidation in country, in Italy and Spain. Is the case for consolidation today still valid? And you can answer that in country or cross border, either or both.
No, I think it is. And sometimes a lot of this consolidation goes a little bit under the radar because we don't see the big deal or the big cross-border deal, which we flagged many times that we see as less attractive in terms of the drivers. I think Theodore has spoken a lot about that in the past. In market consolidation, we still see it's happening, first of all, below the radar in Italy, in Spain, for sure. And we do expect it to continue to happen. Now, of course, some of the financial drivers today are slightly less attractive than they were 2 years ago. The cost is different. Some of the tax incentives are gone or are about to go. And but beyond these very short-term drivers, I think that there is an underlying theme of excess capacity in the banking industry, which needs to be tackled. And at the same time, there is an issue of a maturing industry, which requires a lot of investment, in particular in IT, innovation, and digitalization, and so requires big budgets for investments. This is, I think, a competitive environment where I wouldn't say winner takes all, but definitely, having the size to develop the systems is a big competitive hedge. So I think smaller banks might have a harder time competing if we look 5 or 10 years down the line. And I think this is going to remain as a strategic driver in good and bad times.
Yeah, absolutely. Perhaps not to go off topic completely, but do you see European banks perhaps competing more going forward, not just with other banks, but with, to your point about digitalization, but with neo banks, challenger banks, non-banks, tech firms, payment companies? Is that kind of on your radar as something that you perhaps look at, not for this year necessarily, but just more generally as a sector matter?
It is, although it's not yet clear that the risk is actually coming from this new tech. I mean, personally, I think I see more collaboration agreement and partnerships between incumbents and fintech companies, which is mutually beneficial because essentially a big bank can acquire the technology for a few tens of millions or hundreds of millions, and the fintech can achieve immediate reach to millions of customers. To me, the risk to the established players is more the one coming from big tech. These guys we know have a lot of data, which in the end is the bread and butter of sound credit decisions. So for me, it's more about banks getting ready to compete on a high-to-high level with big tech rather than the smaller players, which of course are going to be trying and eat some of the bank's lunch at the margin. But whether they can actually prove to be successful business models in the medium term, I'm not sure.
Okay, fair enough. Marco, there's a question about capital distribution in 2023. When the question really about dividend payments, and so the thesis, higher rates, higher profits. As you mentioned, asset quality could deteriorate. Can banks afford to raise dividends this year, or will they be allowed to, depending on that?
Yes, I think the way we phrase the question changes the answer. Could banks afford to raise dividends? Yes, because as I showed, there is still a lot of excess capital in the sector, especially at some banks. Is it a good idea to raise dividends during a crisis? In my view, it's not, because it means, first of all, narrowing the scope of strategic options that you have. In a moment of crisis, typically you have opportunities to grow while the others are maybe retrenching a little bit to protect their balance sheets. And then I think the most important aspect is, will the supervisors be comfortable with increased distribution in a more uncertain environment? Let's not forget that the base is very high. I mean, 2021 and 2022 have been exceptional years when it comes to capital distribution. Banks have not only paid out a large percentage of what they were earning in the year, but in some cases, above 100% when you include special dividends and buybacks. So that was a little bit of a catch up to the 2020 dividend ban, but it's a very high base. So I would say I would definitely not expect dividends to go up 2023.
Okay. Very good. Well, there are no more questions, Marco, in the system here. And so unless you have any urgent questions in the next few seconds, I suggest we close the session. So I wanted to thank everyone for dialing in and listening. There will be a YouTube link available afterwards if you want to watch it all over again. But Marco, thank you so much for presenting some great insights. And I'm sure we'll come back later in the year for an update. So
pleasure,
thank you everyone, and wish you a good rest of the afternoon. So it's goodbye from us.
Thank you.